Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
This is the Gold Newsletter Podcast. Thank you for tuning in. This is your host, Fergus Hodgson. If you have not already, hit that subscribe button on YouTube, BitChute, SoundCloud, whatever platform you're on, or add us to your RSS feeds on your podcast app. We have a return guest who gave us a great show before on modern monetary theory. He's a senior fellow with the Fraser Institute in Canada and an emeritus professor at Western Washington University with a focus on in economics. Steven Globerman. So welcome to the show. And we are going to examine all things inflation, and which is obviously a partner topic to modern monetary theory. One leads into the other, so it's a natural follow-up. And the question that has been in my mind as I've been writing about this, and we've done lots of episodes on inflation, is what has been the change over the last decade or two away from the consensus, as far as I'm concerned, in the 90s, that central banks should just focus on restraining inflation. And right now, that just seems to have gotten out of hand. And you're examining this very topic. How much inflation is there? What is going to come of it?
Yeah, thanks, Fergus, for having me back. The first question is, what happened to the focus of central banks? Why does it seem as though they've focused a bit away from the 2% target? Certainly the Federal Reserve has explicitly said, well, we're no longer going to tie ourselves to a 2% target year after year. We'll tolerate a little higher inflation. So the question is why? And here are two possible answers. One is, as the Fed has said, they've actually been below their target for the decade of 2011 to 2020. The inflation rate was actually less than 2%. So, in some sense, what they're saying is, look, we can't control it perfectly, and we're willing to go a little above the target because we know we'll also be a little below the target. That's the official line that the Fed is taking. But I think possibly the more important reason is that income inequality has become a much more important social goal certainly in the governments, not just in the United States, but in lots of other places. And this has really been picked up by, I think, the Federal Reserve. Again, explicitly, the Federal Reserve has said they're concerned about employment prospects for lower income workers. And to the extent that that has become part of the mandate, the explicit mandate, well, inflation is going to be less of a concern.
Yeah, there's so much going on. And this is a sensitive issue to me because I grew up in the 80s and 90s in New Zealand. And 1989, I think it was when New Zealand introduced I guess they called it the Reserve Bank Act, and said that the exclusive goal of the Reserve Bank was to be keeping inflation between 0 and I think it was 2 or 3%. And yeah, and then very soon after, other countries, Canada, now the US was a bit waffly on this. So the Federal Reserve is maybe an exception to this, but almost all the central banks said this is actually a good idea. Just focus on one target, and that is the best procedure. And as you said, there seems to be, how can I put it? Maybe a focus here. You said inequality on somewhat managing the economy from the central bank. So you could say a mission creep. Now, if that is the case, that central banks are less concerned about inflation, why has there been this rhetoric in both Canada and the United States? It's almost like they're echoing each other, that the inflation we observe is just transitory. And I don't even remember really hearing that term used in the past. It seems to be the one in vogue right now. Why are they using that term and reluctant to admit that actually maybe higher inflation is here for a long time to come?
Well, I actually think that you're starting to hear a little bit of backsliding on the transitory theme. But put that aside. Yes. I mean, so certainly a number of the regional Fed chairs, presidents have started to back off a little bit. But to get to your question, I think the Fed and the Central Bank of Canada and the European Central Bank, they all realize that it's critical to keep inflation expectations anchored somewhat. I mean, in my view, and this will sound cynical, but I think it can be defended. The ideal scenario right now, given all the government debt on which interest has to be paid and which has to be refinanced, the ideal scenario for central banks is if the public is always one step behind in terms of inflation creep, because that's a way of taxing without getting all the pushback from an explicit income tax. So you have an inflation tax. Now, you don't want that to get out of hand. I mean, if people catch up and run ahead of what actual inflation is going to be, well, that's the worst possible world for the central banks. But if people are behind in their expectations, that gives the central bank some room to essentially practice what we were talking about last time I was on, which is modern monetary theory.
It does. And I should mention that Steven Globerman, our guest, has shared with me a paper he's working on, which may or may not be out by the time this show goes live. And it explores inflation outlook. So with the Fraser Institute, and if it is live, we'll put a link to it on the show notes. So it's just goldnewsletter.com/podcast. And as you said, in the paper, which you've shared a draft with me, you mentioned that defining transitory is a little bit difficult. And transitory could mean up to 9 months, maybe even a year. So the layman would find that odd that we can go a whole year with inflation of 5% plus or around thereabouts, and that's transitory. It seems like that's a serious amount of inflation.
It is a serious amount of inflation, and the explanation, or at least the justification for the argument that inflation is transitory is that it's all supply side disruptions related to COVID. And one of the themes in the paper, as you know, the paper we're discussing, is my belief that, of course, there are supply disruptions currently, but that there are longer term secular forces that are pushing us towards sustained inflation. And if the central banks continue to monetize debt the way they have over the last 6 to 8 months, we're certainly going to have not only sustained inflation, but inflation that might approach what we had in the period of the 1970s and 80s, which, as you know, averaged about 7 to 8% a year.
Yeah, there's a lot of meat in this paper, and I'm excited for it to be published. Right. So I'm sure the editors will go over it, so I can't really quote from it, but there is a lot of meat. And one of the chilling observations you make is that the level of inflation, reported inflation right now, is higher than what was reported in 1971 prior to the big inflationary period of the 70s and I guess early 80s too. Now, and you go through in detail, let's say, the theoretical discussion of what actually causes inflation and how we understand it or conceptualize it. Now, it is true that, yes, there have been supply side disruptions, but it is the case too that people have been withholding their demand. So there's been reduced velocity. So those two work in the opposite direction?
That's one of the remarkable, to me anyway, one of the remarkable empirical data points is how the velocity of money, which is basically the turnover of money, how much GDP is created per dollar of what I call M2, the M2 money supply, that it actually collapsed. It's been going down for decades, but in the last year to year and a half, it's been lower than it's ever been. So the question is, why is that? And will it continue? And I have to be honest, I haven't seen an academic paper that offers what to me is a satisfactory explanation of why velocity has collapsed. I mean, we know in theory velocity is affected by a number of things. One is the interest rate. If interest rates are low, holding on to money has a relatively low cost. Okay, well, interest rates have been very low. The second thing is uncertainty. This is Keynes' precautionary demand for money. If you don't know what the world is going to look like a year from now and you're worrying about asset prices collapsing, well, you'll hold more money and not hold risk-bearing assets. Well, okay, if those are the two main factors, are they likely to persist going forward? And my argument is no. We're more likely to see higher real interest rates than lower real interest rates for a variety of reasons we can discuss. But secondly, I think now the expectations are turning around so that people are starting to worry about goods and services being priced higher in the future. And that, of course, stimulates a faster spending rate and a faster velocity of money.
Yeah. So both of those factors do seem to be transitory, right? So the supply side shocks, although the supply side shocks have hung around for a lot longer than I expected. And I'm just thinking of the case of Canada, where they're still going into, they're basically returning to some lockdowns, even my home country, New Zealand. So also as people grow in confidence, that velocity we assume will pick up. And this is where we get to the real meat and potatoes of your piece, examining what is the relationship between central bank monetary policy and inflation. And there's this truism that we all hear, that all inflation is a monetary phenomenon, and that it's all a symptom of monetary policy, not of these shocks. But you chip away at that a little bit, but then return to it. I get a bit confused here. So why is it that there has not been a tight correlation between the level of M2 or the money supply and the rate of inflation?
Yeah, and that is a good question. That's been at the heart of a lot of the debate that's gone on over the last 10 years about the role of monetary policy. So let me say a couple of things about that. You mentioned, and it is true, I did some statistical work. There certainly is an ongoing long-run relationship between the growth in the money supply and the growth of inflation. It's not impressively high. And for those of your listeners who might be statistically inclined, we're getting a correlation coefficient of around 0.2, which is by most standards not very impressive. But if you look at particular periods of time, particularly, for example, during the early periods of inflation in the 75 to 85, you get a stronger relationship. So what's going on? Well, part of what intrudes on the relationship between the growth in the supply of money and inflation is the growth in potential output. Right? I mean, inflation is where demand outstrips supply in the economy. Well, if you've got supply of output, the potential supply of output growing relatively quickly, you can pump the money supply, pump up demand, and still have a relatively stable price environment. And in point of fact, and this is another piece of data in the paper, I looked at productivity growth as a rough proxy for the growth in potential output. And in the U.S. in particular, there was a real productivity revolution in the period from around 2000 to 2010, and most economists credit that to information technology, just in general, the internet and tying all production and commercial services. But in the last 10 years, we've had productivity fall off a cliff. So this is a long way of getting to your point, Fergus. I mean, if we have, which we have had in the first half of this year, 25% annualized growth in the money supply, boy, it's going to take an awfully large boom in productivity to be able to offset that kind of money supply growth. And I don't see that. In fact, my argument in the paper is that as low as productivity growth as slow as it's been for the last 10 years, I'm pessimistic that it might even grow even more slowly over the next 10 to 15 years. And we can talk about the reason for that. But if I'm right on that score, then money supply growth has to slow down really dramatically, or we're obviously inviting a return to the 1970s and 80s inflation rates.
The Gold Newsletter is proudly sponsored by Inventa Capital Corporation, a venture capital advisory firm dedicated to the acquisition and development of assets in the natural resource sector. Today, Inventa is one of the premier mining groups with a first-rate portfolio of companies and a world-class team.
Hi, this is Brian London, and I'm here with this week's CEO interview, in which we interview the CEO of one of the companies in the Inventa Capital Group. The Inventa Capital Group being the sponsor of the Gold Newsletter podcast. This week, we have the great pleasure to welcome back Chris Donaldson. Chris is the CEO of Outback Goldfields, symbol OZ on the Canadian Stock Exchange. Chris, you are finally releasing some news after a bit of a hiatus.
And the news that I thought I'd be releasing last June. So it's, as you know, Brian, it's in Victoria in Australia. They've had some pretty heavy lockdowns, and so our programs got delayed for various reasons. One actually was like we couldn't even get our drill because we weren't able to cross state lines. But we were gearing up now. We've got a couple drills going, and things seem to be back on track.
Yeah, it's exciting because, to refresh our audience, you have a really significant land position in what may be the most exciting gold exploration frontier in the world today. Really a rediscovery of the Victorian goldfields, which sparked had its origins in one of the greatest gold rushes in history, and was re-sparked by some significant discoveries by, at that point, Newmarket Gold, and now Kirkland Lake, and now actually merging.
Now at Nico, right? So,
but yeah, it is one of the biggest discoveries, obviously, in recent history. And Outback was able to go in and get a big land position in the midst of all the excitement, and all of a sudden stop with COVID. And now we're looking at the company, I think, at an extraordinarily good entry point in just getting going on a lot of these exciting projects. So with all that said, can you give us a recap of the news you just put out and your plans just ahead?
Yeah, and just to remind your viewers there, we raised $11 million last year and announced in June that we were going to start our big drill program. Of course, that got pushed here. So the good news is we started drilling again, and what's happening in the area, and a lot of companies are doing, is finding these old historic mines. In our case, we're on our property, the Ewengrun property, and going underneath a historic mine called the Golden Jacket Mine. So it was mined 250 gram per ton, so very, very high grade, and then really abandoned because they hit cover, and the cover is a basalt cover or the water table. And so what we've done is we've just completed 10 holes, diamond drill holes at about 150 meters each, right underneath the old historic mine. I would say 80% of that is for us to understand the structure of the area, and 20% is a little bit of fingers crossed, and maybe we get lucky and hit something on the first pass. We've rushed those off to get assays. We're seeing good quartz veining, which was what you want to see. So we're encouraged with that. And at the same time, we brought in a RAB drill to do a RAB program over top and around the old mine. And a RAB drill, rotary drill, it basically drills down 10 meters, and every fifth hole we go 30 meters down. So they're fairly tight spacing in a grid. And the idea there, you're looking for markers. And in this case, it's high levels of arsenic. So we have what they call a portable XRF, which helps identify that right away. And I think we've done about 70 of the planned 200 holes. So when that's all done, we hopefully have some good information and some high levels of arsenic that we can bring back the diamond drill and really have some more focused drilling going on.
So the diamond drilling is really so you can establish the structure and the orientation and where to follow it up. And you're hitting quartz, which is precisely what you want to see. And that's not any guarantee that it will carry grade or high grade, but quartz veining is what you want to look for if you're looking for high grade.
Right.
Of course. And so the RAB drilling is really deep soil sample grid then on that kind of a grid pattern to establish where you have the hot points hot areas to go back with the diamond drill.
That's right. And then when we're going back to the diamond drill, it won't be to understand the structure. It'll be to hopefully make a discovery. So, so this program will go on for about 3 or 4 months, which will be nice. That we'll have a fairly steady bit of news on that. And in the background, we're doing some pre-drill work on our other property called Ballarat West, where we're doing rock chip sampling and we'll do some passive seismic work on it as well, all in preparation for when these drills are in this program is complete at Ewengroon. We'll move those down to Ballarat West, and that'll be the subsequent 4 months. So for the next 8 months or so, we should have drill turning pretty much nonstop. Excuse me, we're into the summer season in drill season in Victoria. So we should have some news flow uninterrupted here for the next quite a while.
So a lot of potential catalysts coming up. I think we should remind people too that you are in an active exploration district, and really any discoveries in the district tend to lift everyone in kind of a broader area play because this area is so exciting.
Yeah, absolutely. I mean, it's the good news is that, if we do make a discovery, other companies seems to be getting rewarded for it as well. E79 had a phenomenal hit and they went up 10x, I think, overnight. And Costerfield just has made a great discovery as well in Fosterville South. So all boats do float when those happen. I mean, the knock on the area over the last 6-7 years is, yes, Fosterville is such a phenomenal mine. It's the highest grade, highest margin mine in the world, but is there another one? And now we're starting to see sniffs that it's likely there are. And so we're quite excited to get in and drilling on our property and see what we can find.
And like I said, a lot of it's really a great entry point for Outback. The market is still coming off of its malaise. We're starting to see some action in gold that is encouraging, not exactly confirming yet in my mind, but very encouraging. A lot of outstanding exploration plays across the spectrum are still mired at near their 52-week lows. So it's a great opportunity for the sector at large. But in particular, you've got this or had to put up with this total lockdown in Australia. And now the news is really going to flow. So, we recommended the company at higher prices, significantly higher prices to gold newsletter readers. And I invested at those levels as well. And it's just an extraordinary opportunity right now for companies for investors looking for a company that's well capitalized. How much money do you have right now?
Yeah, so I mean we've got a little over 6 million. I think our last reported was 8 at the end of the last quarter. But yeah, to your point, is it a good time? We certainly think so. I bought some shares yesterday. Our chairman Craig Perry did as well, and that of course is all public. We suffered from a tough market in general over the summer, and and compounded with the fact we didn't have much news has kind of driven us down. But we're in a good position. We've got all our drilling ahead of us and news ahead of us, and we've got enough money for this entire program for the year. So we're in pretty good shape.
So timing is, of course, everything, and it's a wonderful time to be looking at Outback Goldfields. Investors now have an advantage that very few have had, and lots of good news ahead, and I think share price appreciation because the properties are fantastic and lots of news coming up, drills turning. So Chris, thank you again for joining us, for giving us an update on Outback.
Thanks, Brian.
Yeah, there's so much to say about that. And as you say in your paper, although the correlation is low, that 0.2, it seems to be a lagged correlation, right? In that it comes up a little bit later. And of course, when you take it to the extremes, the famous Argentina and Venezuela examples, then the relationship is clear. If you print money like crazy, it's going to show up. So it's a matter of degree. And maybe one of the challenges for people of my generation is that we've just never known inflation, not a significant amount to really impact our behavior.
That's true.
And maybe we've been lulled into a false sense of security that's just from a primitive era, that we're so sophisticated now that we can control these things. can we? I mean, this is what your paper basically argues, that there is a strong likelihood that the U.S. and Canadian and by proxy other developed economies will enter a period of sustained, or are likely to enter a period of sustained inflation of, let's say, above 5% through the next decade, especially if, as you say, if there's not a big boom in productivity, because if you don't have more, you've got more dollars following the same amount of goods, it's obviously more difficult to deal with. Why is that? So I know this is a big question, but why are we going to return to the same problems of 50 years ago?
Well, I think
haven't we learned our lessons? Haven't central bankers seen what happened then and said, we're going to stop this? It just seems very strange.
Well, I mean, certainly the central bankers say they're going to stop it. I mean, to get back to our earlier discussion, there's no central banker out there that I'm aware of who has been candid enough to say, well, let it rip. If we have 5% inflation, so be it. They're still talking about anchored expectations and anchored inflation. My point is that the margin of error is now much larger on the side of underestimating inflation. I mean, obviously, I could be wrong. The central bankers might get religion starting tomorrow, and you're going to see immediate tapering, and you'll see the central bank rates go up by 1 or 2% everywhere. I don't think that's going to happen. It might, but my message is that if it doesn't happen, we are playing with fire, because the environment we're moving into over the next 10 years is not going to look at all like the environment we've had over the last 10 years.
Yeah. And the point you touched on before is that the expectations are so important, because once people start expecting even inflation, let's say above what the Federal Reserve is trying to tell people, the Bank of Canada is trying to tell people, they almost have to provide the inflation. Otherwise, it's a depressing effect on the economy. Is that correct?
Well, if expectations become unanchored, let's just say, and they are starting to become unanchored. I think to the extent you can believe these surveys, in the United States, the expectation for inflation of survey respondents is more like 3% than 2%. Well, of course, it is 3%. It's actually above 3%. So what happens if people are expecting inflation and the Fed suddenly kicks it into reverse? And, interest rates go sky high, and they don't buy bonds, and inflation starts to come down. Well, with a lag, you're going to have a lot of unemployment, right? Because people's expectations are, well, we're going to have inflation. But if there isn't inflation, companies can't pass on the higher wages that people ask for. And so you're going to get possibly some structural unemployment.
Yeah. Now, let me take you back to one of your points in the paper that is relevant. You mentioned the way both market projections, which we take, let's say, from the tip spread, and from let's just say expert opinion, a consensus of expert opinion, these have demonstrated to be inaccurate in the past. Why do you believe that is the case?
Because from year to year, you can have some unexpected factors that can affect the price level and are very difficult to see. If you go back to 2008, 2009, how many people were actually predicting a collapse in the housing market and a bankruptcy of a major brokerage company and a major Federal Reserve rescue? And that lasted for a couple of years, right? I mean, that really carried through 2013 and 14. I mean, people were very, very cautious with their money, and velocity dropped. And I don't think any experts saw the drop in velocity that we actually experienced. Who saw COVID coming? And who saw the fall in velocity? Because people couldn't spend money. They were locked in their house. So, I mean, on a year-to-year basis, it's very difficult to forecast inflation because you have all these intermediating factors that are difficult to see. But, I mean, one thing is true is that even though long-run inflation forecasts are not all that accurate either, they're more accurate than short-term forecasts.
Yeah. So, yeah, in your paper, you go through a lot of issues and there's a lot to unpack. One country that I've followed and I guess given some praise to is Switzerland. Now, I'm not sure whether you've given attention to them as well, but they have, for some reason, managed to avoid the siren song of inflation and actually had deflation through much of the last decade. Why do you think they are different or people have not followed their lead?
I haven't really followed Switzerland. I mean, if you, as you noticed in the paper, I do look at the OECD European countries. Of course, Switzerland is not part of that, but for all of Europe, which includes countries like the Netherlands and Germany, which have of course been pretty hawkish on inflation. They suffered enormously in the 1970s, 80s. One of the themes in the paper, it's not a big theme, but it's one I make, is that inflation, when it's ripping, inflation is a worldwide phenomenon. It's very hard for any country to escape inflation when you've got inflation going on in the major parts of the world, like the United States, because the economies are so interconnected. And both through trade and exchange rates, that if you have inflation in one place, significant inflation, you're going to have it everywhere. So I don't think anyone's going to escape this. I mean, bad monetary policy in the U.S. is going to have spillover effects everywhere.
Yeah. So the United States is basically exporting inflation to a large degree.
Yeah. But I should say that during the 1970s and 80s, everyone was doing their part, I mean, including OPEC, because part of the explanation, and we should mention this, Fergus, because it's important. I mean, part of the explanation of inflation in the 1970s and 80s was the oil price shock, which again was not really foreseeable. I don't know anyone who was forecasting $100 barrels of oil when oil was trading at $6 a barrel. But if one of the points I make in the paper is that we are, for better or worse, moving away from fossil fuel oil, which is going to create a lot of productivity issues in the transition period. We're moving towards more expensive energy sources. That alone is going to be an inflationary force.
That's true. That is true. And one of the data points that is also relevant, or I found that's stuck out to me, was the way that between 1975 and 1985, was this Canadian? I think American inflation was over 8% for the decade. And that level
8% per year. That's 8%.
Exactly. Yeah. On an annual basis. Yeah. Compound rate. And so that is not out of the question. So we're really talking about a serious level. And like, as I mentioned, people of my generation had just never experienced anything like that. So why don't you talk about that productivity? Obviously, this energy transition, that's part of it, but has the big technology shock of the internet just slowed down, that we've come to a diminishing marginal returns scenario?
This is a big debate amongst economists who study technological change and economic historians. And so you've got two competing viewpoints. One is that one associated with, most prominently associated with Robert Gordon at Northwestern University, who says we've run out of ideas, or we've run out of big ideas. Yeah. And others who say, well, that's just, there's no basis for that. We've always had technological change and we'll have it in the future. Okay, why am I pessimistic? One of the reasons I'm pessimistic is the evidence that I've seen that it costs more in R&D dollars to create I'll call it a unit of technological change. I mean, typically it's measured by patents or new products, but some measure of technology. Yeah. So it is costing more. And the question is why? Well, maybe we have really scrimped on basic research for many years, and maybe the big ideas are more scarce than they were 20 years ago. That's one possibility. I think the other, and maybe the more important in my view, is that we have a sea change going on in economic policy. And I'll talk about the U.S. because it's most obvious there. Tax rates are going up. Capital gains tax rates in particular are going up. We have an administration which believes in regulation. And I mean, we're getting regulation that is going to take us back to the 1960s, given the people that have been appointed to positions in cabinet and in regulatory positions. High taxes and lots of regulation are those aren't good recipes for productivity growth. And that's part of my worry.
Yeah, the bit about the taxation is important because not all taxes are equal. But taxes on capital gains corporate taxes and capital gains are especially harmful for investment and growth, because that is the money that on the margin is going to be used to reinvest and to grow an economy. And the level of capital per worker is so crucial for our productivity. I mean, this is one of the crucial tenets of economics, that having capital per worker is what generates our productivity. So any barrier to that is a serious problem. And I'll just add too that the Fraser Institute, which is an incredible think tank based out in Vancouver, that does a lot of in-depth, rigorous research in Canada, they have been sounding the alarm over the last couple of years about the declining investment in Canada. And this is going to have long-term effects, yes, on productivity for the country. Now, we can debate why that is, but it's a fact. It's just already been happening for the last few years. So the productivity side, yeah, it is a serious concern. Now, are there any other issues in the paper that I did not touch on that you think are pertinent? I mean, some of it is more technical that I'm not sure we want to go into, deconstructing this equation of money. I'm not sure that's so important, but the big issue is just that the consensus seems to be, or the central bank consensus is that by early 2022, so just a few months, we'll basically be back to about the 2% normal rate, right? The target rate. And you have found compelling evidence that that's just not the case.
Yeah. And I think part of the message, Fergus, that also needs to be kept in mind is are central banks as independent as we like to think they are? And I make the argument in the paper that there's real reason. I'm not questioning the motivation of the central bankers, but you can certainly think that there's a lot more political pressure on central banks to tolerate inflation than there was 10 or 15 years ago. And what I have in mind is the very large indebtedness of Western economies. Now, you might say, well, but for every debtor, there's a creditor. So why isn't there a lot of pushback from the creditors? Well, because the central banks are now largely the creditors, and they don't have a profit and loss statement. I mean, they can endure as much pain from inflation as you want to inflict on yourself.
Yeah, they can take it, exactly. Yeah. So if the lenders are just the central banks, so what? They'll just eat the losses or whatever, and the loser is really the people holding the currency. So yeah, there's a lot more to say about that. I tend to agree, and this is the point I opened with, that the environment has changed, and the apolitical status of central banks is less, or it has withered away a little bit there. Now, yeah. So does that mean that the pressure for alternative currencies is going to rise? That the competitive pressure, albeit minor, from alternative currencies is going to become more of a factor?
Well, we discussed that a bit when we talked about modern monetary theory, and I guess my answer then and my answer now would be yes, but of course you can expect lots of regulation, because one of the things governments don't want to lose is their sovereign currency status. And so, as you know, in periods of rampant inflation, of course you have people looking for alternative means of payment that don't depreciate by the second, and that may be cryptocurrencies, even regulated. Maybe gold. I have to say that I'm very surprised that gold prices are not reacting to what I see as an unfolding inflation scenario. But I'm I'm doubling down on that bet.
One of our other guests, Peter Bookfire, just tweeted this morning too, that he is also surprised and doubling down. So you're not alone there. One other question which we have examined plenty is the capacity for central banks to actually raise interest rates. Could they actually do it in this environment? And as you say, they're basically almost without dispute in negative real terms, right? The rates are negative in real terms. Can we actually go through a Volcker scenario, right? I think it was Paul Volcker was his first name, from the 80s, right, who just said, we're not going to take it. We're going to up the rates and you're going to cut your deficits and sort it out. Can that actually even happen now?
Well, let me take that in two parts. Technically, can the central bank raise rates? The answer is yes. They
Sure.
have the technical tools to do that. Of course, to me, the more fundamental question is, will they do it?
Yes.
And,
Okay.
Sure.
Sure.
And there, I think certainly if rates of inflation got to 8% or 7%, I think central banks, as long as they had some shred of independence, would feel obliged to raise rates. But what happens in that environment is, in some sense, the opposite of what happens when you have inflation expectations going down. When inflation expectations are going up, people are trying to get rid of money, velocity increases, and that means you have to raise interest rates even more. Paul Volcker raised 10-year bond rates went to 21%.
Yeah, I was thinking high teens, but yeah, so even over 20%, right? So almost unthinkable at this point. Yeah.
Yeah. And inflation never got really above 14% at its highest per annum. So the real interest rate was 6 to 7%. Why did it have to go so high? Because the velocity of money was increasing, because people were saying, we're not holding cash. Cash is trash. We're getting rid of it. So really the job of the central bank becomes much harder when inflation expectations become unanchored, as they are doing now. And so can central banks stop the inflation? Yeah, they can be brutal like Paul Volcker was. Do we want to go through that? I don't think so. I think we'd rather have the bank act sooner and prevent the problem from happening than react and have to deal with totally unanchored inflation expectations. And then you have double digit to more in interest rates. And you're going to see a lot of people walking away from houses. You're going to see a lot of businesses closing because they're not used to positive real interest rates, even let alone 7 or 8% real interest rates.
Yeah. And one source of maybe reason for them not doing it or being very reluctant is that in normal times, I guess the non-COVID times, they would have already done it, right? They would already have raised interest rates before they got to, before inflation got over 5%, or in Canada, I think 4.5%, because they're already way outside their normal range, or they're what they're supposed to be at. So they've shown that they are very reluctant, at least for the near future. Anyway, I just realized that there is pressure on them to not do that. And as you said, the independence is really being tested right now. And I don't know what's going to come of it, but I'm excited for your paper to go out. I'm going to share it widely because I think it is a very even-handed, sober view of it, being respectful towards both sides of this debate or various perspectives, and acknowledging the challenges of the connections between money supply and inflation. So I don't know if I'm allowed to give the title yet. Well, it's just referring to the outlook for inflation, and it'll be up with the Fraser Institute. It's just fraserinstitute.org, a think tank. We've been speaking with Steven Globerman, a senior fellow there and emeritus professor at Western Washington University. So, Steven, thank you for your time, and I appreciate just this honest research you've been doing.
Thanks, Fergus.